The ultimate retirement income strategy for 2026. What if your retirement account was basically a golden egg? Like, you've spent years, maybe decades, quietly filling this thing up, contributing every month, watching it grow, and then one day you crack it open. And instead of just a pile of money that slowly disappears as you spend it, it just keeps producing, month after month, year after year. Like the egg never actually runs out. That sounds like a fantasy. Most people assume retirement works like a timer. You save up a number, you retire, you start spending it down, and somewhere in your 70s or 80s, you start doing this quiet, anxious math in the back of your head about whether it's going to last, whether you saved enough, whether you're going to outlive your money. And that fear, the fear of outliving your money, is one of the most common financial anxieties Americans carry into retirement. More common than the fear of not saving enough in the first place. Because not saving enough is at least a problem you can see coming. Running out of money at 79 is a different kind of terrifying entirely. But here's what most people don't realize. The difference between a retirement that slowly drains and a retirement that sustains itself, even grows, isn't just about how much you saved. It's about how you structure the income, the order you pull from different accounts, the way you position your assets to keep producing rather than just sitting there getting spent. My name is Jack, and I'll be honest, retirement income strategy is one of those topics that sounds dry on the surface and turns out to be one of the most genuinely important things you can understand about money. Because getting this right doesn't just affect your finances. It affects whether you spend your retirement feeling secure and free or quietly anxious and counting down. So today, we're going over the ultimate retirement income strategy for 2026. The framework that makes your money last, keeps it growing, and lets you actually enjoy the life you spent decades building toward. Let's crack this open. 1. The retirement income problem. Nobody warns you about, okay, so here's the thing that surprises most people when they actually sit down and think about retirement income seriously for the first time. Saving for retirement and living off retirement are completely different financial problems. And the skills and strategies that helped you accumulate wealth, consistent investing, high savings rate, riding out market volatility, are actually not the same skills you need to distribute that wealth efficiently without running out. Let me explain why. When you're accumulating, building the nest egg, market volatility is mostly your friend. When the market drops, your monthly contributions buy more shares at lower prices. You have time on your side. A bad year in the market is just a buying opportunity if you're 35 years old. But in retirement, market volatility becomes your enemy in a very specific way. There's something called sequence of returns risk. And it's one of the most important concepts in retirement planning that almost nobody outside of financial planning circles actually knows about. Here's how it works. Imagine two people retire with identical $1 million portfolios on the same day. Identical average returns over 20 years. Both portfolios average 6% per year. But person A experiences bad market years early in retirement, then good years later. Person B experiences good years early, then bad years later. Person A might be outside, who got the bad years first, runs out of money years before person B, even though their average returns were identical, because person A was forced to sell shares at low prices early on to cover living expenses, leaving fewer shares to participate in the eventual recovery. Person B's portfolio had time to grow first, creating a buffer that absorbed the later bad years. Sequence of returns risk is real. It's significant. And it's the reason retirement income strategy is not just withdraw 4% and call it a day. The order matters. The structure matters. How you position your money before and during retirement has an enormous impact on whether it lasts 20 years or 40. That's what we're going to build today, a structure that protects you from this risk while keeping your money productive for as long as you need it. 2. The bucket strategy. The foundation of smart retirement income. All right. The single most powerful framework for retirement income, and the one that addresses sequence of returns, risk most directly, is something called the bucket strategy. And once you understand it, you'll never think about retirement income the same way again. The idea is simple. Instead of thinking of your retirement savings as one big pile of money you slowly spend down, you divide it into three distinct buckets, each with a different job to do and a different time horizon. Bucket 1. The safety bucket. This is your short-term cash reserve. It holds 1 to 2 years of living expenses in cash or cash equivalents, high-yield savings accounts, money market funds, short-term CDs. This is the money you actually live on day to day. Your bills get paid from this bucket. The purpose of Bucket 1 is to completely insulate you from short-term market volatility. Because when the market drops 30%, and at some point in a 30-year retirement, it will, you are not selling a single investment to cover your expenses. You already have 1 to 2 years of living costs sitting in cash. You can ride out the downturn without liquidating anything at the worst possible time. Bucket 2, the income bucket. This holds 3 to 10 years of living expenses, invested in relatively conservative income-producing assets. Think bonds, dividend-paying stocks, REITs, balanced funds. This bucket isn't trying to grow aggressively. It's trying to generate steady, reliable income that periodically refills Bucket 1. When the market is doing well and Bucket 1 gets depleted, you pull from Bucket 2 to top it back up. Bucket 2 is your buffer. It gives Bucket 1 time to be replenished without touching your growth assets. Bucket 3, the growth bucket. This is where your long-term growth assets live. Broadly diversified stock market index funds. Assets that are going to be left alone for 10 or more years to compound aggressively. This bucket is not touched in the short term. It's the engine of your long-term wealth sustainability. And because you're not depending on it for current income, you can afford to let it ride through market volatility without panic. Over time, when markets recover and Bucket 3 has grown significantly, you periodically rebalance, moving some gains from Bucket 3 into Bucket 2, which periodically refills Bucket 1. The whole system feeds itself. The golden egg essentially keeps producing. 3. The account withdrawal order. This one decision saves you hundreds of thousands. Okay, so you've got your buckets. Now, which accounts do you pull from first? Because this is where most people make a very expensive mistake, and it's a mistake that's almost invisible until it's too late. Most retirees have money sitting in at least 2 or 3 different types of accounts: a traditional 401k or IRA, a Roth IRA, and maybe a taxable brokerage account. Each of these accounts has different tax treatment, and the order in which you withdraw from them has a dramatic effect on how much of your money the government takes and how long your portfolio actually lasts. Here's the conventional wisdom on withdrawal order, and it's a solid starting point for most people. First, taxable brokerage accounts. These are taxed at capital gains rates, which are generally lower than ordinary income rates. Pulling from these first keeps your taxable income lower in early retirement, which has cascading benefits. It keeps you in lower tax brackets, it reduces how much of your Social Security gets taxed, and it preserves your tax-advantaged accounts to keep growing. Second, traditional 401k and IRA accounts. These are taxed as ordinary income when withdrawn. You're going to have to pull from these eventually anyway, because of required minimum distributions that kick in at age 73. So you work through these in the middle years of retirement. Third, Roth IRA. This is your last resort and your biggest long-term asset. Money in a Roth grows tax-free and comes out tax-free. And crucially, Roth IRAs have no required minimum distributions. You can leave this money growing for as long as you want, pass it to heirs tax-free, or use it strategically in years when your other income is low. The Roth is your most powerful retirement asset specifically because it gives you tax flexibility. In a year when your other income is low, you pull from taxable or traditional accounts. In a year when your other income is high, you pull from the Roth, because Roth withdrawals don't count as taxable income and don't push you into a higher bracket. This withdrawal order, executed thoughtfully, can genuinely save a retiree $200,000 to $400,000 in taxes over the course of a 25 to 30-year retirement. Not because of any loophole or trick, just because of which account you pull from in which year. 4. Roth conversions, the pre-retirement move that changes everything. Here's a strategy that gets talked about in financial planning offices constantly, but almost never makes it into regular people's conversations. And it's one of the most powerful things you can do in the years leading up to retirement. Roth conversions. Here's the situation a lot of people find themselves in. They've spent 30 years contributing to a traditional 401k. They've got $1.2 million sitting in that account. And every dollar in there is going to be taxed as ordinary income when they withdraw it, including all the growth. At $1.2 million and a 4% withdrawal rate, that's $48,000 a year in taxable income just from that account alone. Add Social Security and any other income, and suddenly their tax bill in retirement is larger than they ever anticipated. The Roth conversion strategy addresses this. In the years between when you retire or start winding down work, and when Social Security and required minimum distributions kick in, you often have a window of relatively low income. And in that window, you can convert chunks of your traditional IRA or 401k into a Roth IRA, paying the tax now at your current lower rate to permanently eliminate the tax burden on that money in the future. The math on this can be genuinely significant. If you're in a 22% tax bracket during your conversion years and would otherwise be in a 32% bracket in peak RMD years, every dollar you convert saves you 10 cents in taxes. On a $500,000 conversion over several years, that's $50,000 in tax savings. Real money. The window for this strategy is typically ages 60 to 72. After retirement income drops, but before Social Security and RMDs create a taxable income floor. And working with a tax professional to optimize the conversion amounts each year, staying within specific bracket thresholds, is where a lot of the value gets captured. It's not exciting. It's not a hack or a trick. It's just understanding how the tax system works and positioning yourself inside it strategically. 5 million. Social Security. The decision worth up to $200,000. Okay, we need to talk about Social Security, because almost everyone has it available to them, and almost no one makes the optimal decision about when to take it. Here's the setup. You can claim Social Security as early as age 62. You can wait until your full retirement age, currently 67 for most people, to receive your full benefit. Or you can delay all the way to age 70, at which point your benefit is about 77% higher than it would have been at 62. 77% higher. That is not a small difference. Here's what that looks like in real dollars. Say your full retirement age benefit at 67 is $2,000 a month. At 62, claiming early, you'd get about $1,400 a month. At 70, delaying, you'd get about $2,480 a month. That's $1,080 a month more than the early claiming option, every single month, for the rest of your life. If you live to 85, which is not an unreasonable expectation with modern medicine, the difference in total lifetime Social Security income between claiming at 62 versus waiting until 70 is somewhere in the range of $150,000 to $200,000. Just from the timing of the claim. Now, there are reasons to claim early. If you have serious health concerns and don't expect to live into your 80s, early claiming might genuinely make sense. If you desperately need the income and have no other options, you take what you can get. But for most people in reasonable health with other assets to draw from, delaying Social Security as long as financially possible is one of the highest return, zero-risk financial decisions available. Because Social Security is essentially a guaranteed inflation-adjusted annuity. Every year you delay, you're buying more of that guaranteed income at a very favorable rate. The bridge strategy, using portfolio withdrawals to fund living expenses from age 62 to 70, specifically to delay Social Security, is worth running the numbers on for almost everyone. The math is often compelling. 6. Making the golden egg last. The 4% rule and its limits. Hey, quick genuine moment before we get into this next section. If this video is connecting dots you've never had connected before, if you're seeing a retirement income picture that actually makes sense for the first time, it would genuinely mean a lot if you subscribed. It's a small thing on your end and a big thing on ours. Just hit subscribe and let's keep going, because we're getting into the part that makes everything else stick together. The 4% rule. You've probably heard of it. It says you can withdraw 4% of your portfolio in year 1 of retirement, Adjust for inflation each year, and historically, your money has lasted at least 30 years in almost every market scenario studied. It's a solid rule, well-researched, and a genuinely good starting point. But in 2026, there are a few nuances worth knowing about, because the original research was done in a different interest rate environment, and because the 4% rule was designed around a 30-year retirement. If you retire at 55 and live to 90, you're planning for a 35-year retirement. The math changes slightly. A few updated guidelines that make sense in the current environment. If you're retiring at 65 or later, the 4% rule holds up well historically. Stick with it as your baseline. If you're retiring early, say 55 to 62, consider a more conservative 3.3 to 3.5% initial withdrawal rate. The longer time horizon requires a little more cushion. Build in flexibility. The rigid 4% plus inflation formula is actually slightly more fragile than a flexible approach, where you spend a bit less in down market years and a bit more in strong years. Studies show flexible withdrawal strategies outperform rigid ones over long periods because they reduce the damage from bad sequence of returns years. And keep your portfolio allocation sensible throughout retirement. The old conventional wisdom was to shift heavily into bonds as you age. Modern research suggests keeping a meaningful stock allocation, 50 to 60%, even well into retirement, because the growth engine of equities is what makes a 30 or 35-year retirement survivable. Too conservative too early actually increases the risk of running out of money, not decreases it. T7. The income streams that make retirement truly bulletproof. Okay, here's where we talk about what actually makes the difference between a retirement that's technically fine and one that genuinely feels secure and abundant. Multiple income streams. The most financially resilient retirees aren't the ones with the biggest single account. They're the ones whose income comes from several different places, so that no single market movement, no single policy change, no single bad year can derail the whole thing. Here's what a genuinely bulletproof retirement income picture looks like. Social Security, your guaranteed inflation-adjusted government and income. Delayed as long as possible for maximum benefit. Portfolio income. Withdrawals from your investment accounts using the bucket strategy and smart withdrawal order we've talked about. Rental income. Even a single rental property can generate $1,000 to $2,000 a month in net income, providing a stream that's largely independent of the stock market and continues regardless of what equities are doing. Dividend income. A portfolio positioned with a meaningful allocation to dividend-paying stocks generates regular cash flow without requiring you to sell shares. Dividends from a $500,000 allocation yielding 3% produce $15,000 a year in income, $1,250 a month, just from dividends alone. Part-time or passion work. A lot of early retirees find that doing something they enjoy, consulting, coaching, creative work, a small business, generates $1,000 to $3,000 a month without it feeling like work at all. This income stream reduces portfolio withdrawal pressure dramatically in the early years of retirement. None of these streams need to be huge individually. The power is in the combination. When you've got Social Security covering your baseline, dividend income covering some expenses, a rental property adding another layer, and portfolio withdrawals handling the rest, you're in a position where any single disruption is manageable. The whole structure doesn't wobble because one piece moved. That's what financial security in retirement actually looks like. Not one giant account. A web of income sources that catch you from every angle. 8. Healthcare, the expense that breaks retirement budgets. I'd be doing you a disservice if we got this deep into retirement strategy without talking about healthcare, because it is consistently the expense that breaks retirement budgets more than any other single factor. And most people dramatically underestimate it. If you retire before 65, before Medicare kicks in, you need to cover your own health insurance. And it is expensive. A couple in their early 60s buying health insurance on the open market can easily pay $1,500 to $2,500 a month in premiums alone. Before deductibles, before out-of-pocket costs. Just the monthly premium. That's $18,000 to $30,000 a year in healthcare costs before you've seen a single doctor. For a couple planning on $70,000 a year in retirement spending, healthcare alone is 25 to 40% of the budget. That dramatically changes the retirement number you need. After 65 and Medicare eligibility, costs drop, but don't disappear. Medicare Part B premiums. Supplemental Medigap coverage, prescription drug coverage, dental, and vision, which Medicare doesn't cover. A realistic healthcare budget for a 65-year-old couple is still $8,000 to $15,000 per year. And over the course of a long retirement,